Good day, dear students. I am Dr. A. Sairam, MCom, MPhil, PhD, UGC NET in Commerce, MBA, Post-Graduation Diploma in Financial Management, and ICAA Final. Welcome to my channel, Professor Guru Kalvi. This is a channel where you can find notes relating to subjects in commerce, where we have the e-content relating to all these subjects. So in today's video we will be looking at the format journal entries relating to amalgamation of companies. In earlier class we looked at some of the theoretical aspects and fundamentals of amalgamation. In today's class we are getting into the accounting aspects of amalgamation. So as I said earlier, there are two important companies as far as amalgamation is concerned. One is the selling company, the another one is the buying company. So now we will look at the journal entries in the books of selling company. The first and foremost journal entry is to transfer the assets of the selling company to an account, from where it will be much easier to have accounting transaction and recording of transactions. So what we do, we create an account called realization account, as like we studied in partnership business. In case of dissolution of a firm, we create something called realization account, is it not, to transfer all the assets into that. Likewise, in case of amalgamation, before selling, the first and foremost thing that we do is we open a realization account, where the first step is to transfer the assets to that particular account. Dear student, asset will always appear on debit side, is it not? It always have debit balance, where it appears on the asset side of the balance sheet. But just look at this journal entry. To transfer it, we first put the assets on the credit side, and where we are transferring it, we are transferring it to the realization account, so it is on the debit side. So first journal entry is realization account debtor to asset account. Then we have transfer of liability, so it is the other way around. Liabilities will always have credit balance, it will appear on the liability side of the balance sheet. So to transfer it, we first put it on the debit side, liabilities account debtor. Where we are transferring it, we are transferring it to the realization account, so it is on the credit side. So the second journal entry for transfer of liability is liabilities account debtor to realization account. Then third journal entry is for making the purchase consideration due, right? It is what I am going to receive, so I first create it as due, then the actual receipt will be recorded. As the case with issue of shares, where in case of allotment, or in case of first call or second call or third final call, what we do, we first create the due entry. Likewise here, in case of purchase consideration, we first create the due entry. The journal entry is purchasing company account debtor, the buying company, right, the other company. Who is going to give me? The purchasing company is going to give me the money. So purchasing company account debtor to realization account. So first I make it due, then we will record actual receipt of purchase consideration. So the first and foremost thing as far as amalgamation in journal entry in the books of selling company is that we need to create a realization account. First journal entry is to transfer the asset, second journal entry is to transfer the liability, then third one is to make purchase consideration due. Easy? So this is how we go forward with the journal entry as far as selling company is concerned. The fourth journal entry is to record the assets taken over by the purchasing company, the revalued values of assets that are taken over by the purchasing company. So here, who is taking it over? Purchasing company is taking it over the asset. So we record purchasing company account debtor. We have already transferred asset to which account? Realization account. Now this asset is being taken over by the purchasing company, so we are crediting the realization account, thereby we are cancelling whatever we have recorded there, we are giving a counter entry here. So the journal entry will be purchasing company account debtor to realization account. In case of transferring, realization would have appeared on the debit side. Now we are recording realization on the credit side. Then fifth journal entry is liabilities taken over by the purchasing company, where the journal entry is the other way around. It is very simple. That now realization account debtor to purchasing company account. In case of liability, irrespective of whether the buying company is taking it over or not, they are bound to pay for it. So now, if say for example sundry creditor of X Limited, if the Z Limited is taken over, it implies that Z Limited needs to pay. So we put the purchasing company on the credit, and once again we have transferred the liability to the realization account earlier in the second journal entry. Now we are giving a counter entry here at the revalued amount. So the next two journal entries that we are seeing now are transfer of taking over of the asset by the purchasing company, where the journal entry is purchasing company account debtor to realization account. Next one is liabilities taken over by the purchasing company, where the journal entry is realization account debtor to purchasing company account. Now next one is the actual receipt of purchase consideration. In third journal entry we made the due for purchase consideration, is it not? Now what we do, we receive the purchase consideration. Purchase consideration may be received in three different ways, either by shares or by debenture or by cash. Cash in a sense bank, right? So the journal entry in case of received by shares is shares in purchasing company account debtor to purchasing company account. Shares in purchasing company account debtor to purchasing company account. So here who is giving it? The purchasing company is giving me the amount. So I credit the purchasing company, and what I receive, shares in the purchasing company. Likewise in case of debentures, debentures in purchasing company account debtor to purchasing company account. When I receive it as cash, bank account debtor to purchasing company account. If say for example all these three appear in exam in a single question, the journal entry will be shares in purchasing company account debtor, debentures in purchasing company account debtor, bank account debtor to purchasing company. That's it. So all these three will be shown in a single journal entry. So the sixth and important journal entry is receipt of purchase consideration. The first one is receipt by way of shares, shares in purchasing company account debtor to purchasing company account. If it is received by way of debenture, debentures in purchasing company account debtor to purchasing company account. If it is received by way of cash, bank account debtor to purchasing company account. The next one is realization expenses paid. Someone will take the effort to realize all these assets and liabilities, is it not? Revaluation or whatever it may be, all legal charges that are related. So that is where the realization expenses comes into play. Realization account debtor to bank account. So after making all entries on debit and credit side of realization account, finally the realization account will show some profit or loss depending on the kind of transactions that has happened. If the realization account shows profit, who should receive it? The equity shareholders of the company should receive it. They are the original owners of the company, is it not? So the journal entry will be realization account debtor to equity shareholders account. So it should go to equity shareholders account. If it is loss, once again who is going to bond the loss? Once again the equity shareholder account debtor to realization account, loss on realization. So the next 7th and 8th journal entry are realization account expenses paid, where the journal entry is realization account debtor to bank account. In case of profit on realization, realization to equity shareholders account. In case of loss on realization, equity shareholders account data to realization account. Now we come to the 9th journal entry, transfer of share capital, right. So in case of share capital, it will always appear on balance sheet liability side. It has credit balance, is it not? To transfer it, first we need to make entry on the debit side. So that is why we are putting equity share capital on the debit side. And to whom we are going to transfer it? We are going to transfer it to the shareholders. So journal entry will be equity share capital account data to equity shareholders account, right. So final transfer. The next one is transfer of reserves and surplus. So this reserves and surplus belongs to who? It belongs only to the equity shareholders. In case of preferential shareholders, if they are participative preferential shareholders, then alone they will be taken into consideration. But generally all reserves, the residual profit, the retained earnings belongs to equity shareholders only, because they are the original owners of the company. The general reserve, the P&L and the capital reserve or whatever reserve it may be will appear on balance sheet liability side, which will normally have credit balance. Now we are closing the account. So what we do, we put it on the debit side, general reserve account debtor, P&L account debtor, then capital reserve account debtor. To whom we are transferring it? We are transferring it to the equity shareholders. Okay, the final entry is distribution to shareholders. Now we are going to pay back the whole amount to the shareholders. We have earlier transferred share capital to the shareholders, we have transferred all reserves to the shareholders. Now it is time to pay them back and close the books of accounts. Equity shareholders account debtor. So how we are going to pay, that will be explained in the problem. It might be either one of these three methods. Number one is to have shares in the purchasing company, where the entry will be to shares in purchasing company account. Debentures in purchasing company, where the entry will be debentures in purchasing company account. And finally by way of cash or bank, where the entry will be bank account. So journal entry is equity shareholders account debtor to shareholders in purchasing company account to debentures in purchasing company account to bank account. So dear students, first we started with transferring the assets and liabilities to realization account. Then we have creating due for realization, purchase consideration in realization account. Then we had revalued assets and liabilities being taken over by the purchasing company. Then we have transfer of share capital to the equity shareholders, where the journal entry was equity share capital account debtor to equity shareholders account. Then we have transfer of reserves and surplus to the equity shareholders, where the journal entry is general reserve account debtor, P&L account debtor, capital reserve account debtor to equity shareholders account. And finally we close the books of accounts finally by paying the equity shareholders, where the journal entry is equity shareholders account debtor to shares in purchasing company account, to debentures in purchasing company account, and to bank account. So these are some of the journal entries which we will be looking in problems in upcoming videos as far as amalgamation selling company is concerned. Thank you for listening. We will meet back in next video. The grace of my Guru, you all will reach greater heights. Thank you, students.